Welcome to the Southwest Florida Real Estate Update hosted by the York Group of Downing Fry Realty. Our show will bring you the most up-to-date information on the local real estate market, presented by leading experts in the field. Today's guest is Robert Slaughter with U.S. Bank.
Well, thank you, Robert, for coming on the show today. We're going to talk obviously about mortgages, but before we do that, tell our audience a little bit about yourself.
Hi, so my name's Robert Slaughter. I currently am the branch manager with U.S. Bank, and I have a team that's located throughout Southwest Florida. Been in the business for about 27 years and about 5.5 with U.S. Bank, and I've worked with Jim for 20-something years.
That's right. You've done most of our mortgages for our clients. Let's just talk about what's going on with the market, and I want to just tell our viewers first. A year ago, what were the rates, and what are they today, and what would the difference be? I know you've told me this before, on like a $500,000 mortgage in payments.
I have no idea what the difference would be, but the rates have run up there. I mean, we had a run up into the 6% range last year. The run up really started at the first quarter of 2022. And we're probably about in that same range. We're in the mid-sixes now on a 30-year fixed rate mortgage on that. Jumbo rates are a little less than conforming loan size rates, but somewhere in that mid-six range.
So you're saying last year the rates were about the same as this year?
Maybe a little lower, but there was a big jump, yeah, okay. And it was about 18 months ago or 20 months ago.
Well, I'm having such a good time. Time just flies.
Yeah.
So, but they were in the threes back then, 18 months ago. So they've doubled.
Yeah.
So payment wise, how's that?
Probably. I mean, you're seeing payments about doubling. We have a spreadsheet we run, on for every eighth in interest rate. Some of the stuff last year, people are much more apt this year to pay points to buy down, which is an upfront fee to try and buy down rates. We have some sellers that are doing some temporary buy downs where they're trying to entice people to buy the property, where they subsidize the rate for the first and second year, so it kind of steps up to its normal payment. So we've seen some of that, not as much in Southwest Florida. We still are, have a healthy, economy down here. So housing markets, I don't think that we've seen too much locally, but I've seen that, come up throughout the state.
And explain to our viewers a non-conforming loan versus a conforming loan.
Yeah, so the Federal Home Loan Bank, which is the governmental entity that's responsible for Fannie Mae, Freddie Mac, FHA, all the quasi-governmental entities, they kind of set what they consider to be the high end of a middle-income mortgage, which is $726,200. So that recently went up. Usually every year, every couple of years, they look and see what the average sale prices are, and they come up with that. Loans above that are considered to be bank portfolio or jumbo loans. Loan levels at that or below are generally, the U.S. Bank will still service a loan, but we take and sell the loan in bulks to either Fannie Mae or Freddie Mac, which is quasi-governmental.
And how about credit scores? I just want to tell our viewers that's changed a little bit too over the years.
Yeah, so the credit profile, we've been seeking to lower some of our scores, not as much as some of our competition, but you'll see credit scores and pricing improving on lower credit scores. The Federal Home Loan Bank just made that announcement.
Right.
And so first-time home buyers within 100% of the median area income will see a reduction in rate based on the Federal Home Loan Bank's charter. What they're saying is that they want to entice first-time home buyers into the market, and so they're offering out some pretty attractive interest rate options for that.
So credit scores, tell them about the tiers.
Yeah.
People, that's what I was.
Yeah, so basically the tiers you've got really would be, sub 600 tiering all the way up to about 780. But every 20 points in a
Right.
credit score will go into a different bucket for pricing purposes. And so generally if you're at, so they just added 2 new tiers. So I think 780 and above is the newest highest tier. That used to be 740 and above, but they've created some tiering on that. And the idea on the tiering was lower credit scores may have more credit risk. And so, they would be charged a slightly higher interest rate because of that lower credit score.
Now it's changed.
Now it's changed. The government's decided that the emphasis should be on first-time home buyers and those at 100% or less on the area median income.
And if a person's filing for a loan or doing an application, just give them a little background on what they need to get prepared for that, because even people that have owned homes for a long time really don't know. They haven't had a loan in a long time, so it's different. It's changed.
Yeah, so standard documentation, is, always if I'm talking to somebody and I haven't, pulled their file, start talking about 2 years of personal income tax returns. If they own more than 25% of their business, we need 2 years of corporate tax returns. We need 2 months of bank statements. We need W-2s and year-to-date pay stubs if that's applicable. So that's kind of the standard documentation guidelines. A lot of feedback these days is coming from the ability to alternative document. So we have systems that will run through if you're a W-2 employee and your employer participates, we'll automatically get your income numbers sent to us. It won't happen on the tax returns, so we'll still need the full tax returns where applicable. But we have had some ability to document bank statements and W-2 income from outside sources.
And tell some of our first-time home buyers here a little bit about, not maybe buying a car during the process or before they file for an application, or open up a charge account, any of those things.
Yeah, we're starting to see some really high car payments. So I think the last week somebody said no Land Rover before you own land. Anyway, it was a bad joke, but anyway, so the idea on that with car payments, what you want to do is you don't want any surprises during the application process. If you're applying and you're thinking about new debt, trading in your car, things like that, you really want to wait until you want to hold those thoughts until after you close on your loan. Lenders pull credit up front, which is good for 120 days. But we'd also look at new inquiries into your credit to see if there's potentially any new credit. Also, 10 days prior to closing, a lender will do a refresh. We won't refresh the balances of your accounts, but we'll look for potentially new inquiries and if there's new credits come in on that. So usually I tell people, hold off your purchases, anything you're looking to do. If you're looking to remodel, don't necessarily go to the store and purchase it all on a new store credit card or something like that prior to getting yourself closed.
And just one more thing about first-time home buyers is that what is the ratio of income versus the loan, and what can affect that? Like if you're in a condo fees or taxes, etc.
Yeah, condos are always a great quandary because they're lower priced, but they've got HOA fees attached to them, the quarterly homeowner association fees. Since that is an ongoing debt, we have to count that into a borrower's payment. So although condos price point are cheaper, the borrower can actually qualify for less dollar-wise on a condo because of potentially some of those homeowner association fees on that. And you've seen a whole range of that depending on what the amount of these are. So normally when I've talked to one of your clients, we kind of go through, you actually want to update before you put an offer in. I know you've got your clients, you want me to update the tax number, you're talking to Chris on the insurance end and getting an insurance quote, you're having me plug in an HOA fee to make sure that
there's no surprises.
Yeah, no surprises.
And what's going on with the banking industry right now with some of the failures? Or should we be concerned or not?
Yeah, so this is going to be timed issue. So at this point, we saw First Republic Bank. It was recently failed and bought out by J.P. Morgan Chase. I think the liquidity in the sector, when I look at the banks that have gone under, they appear to be more of a boutique type lender. First Republic was very heavy on wealth client and keeping extra wealth assets, things like that, doing a lot of portfolio lending. So I think when we've seen things like that, that is where we've seen banks have challenges with liquidity on that. I think most bank stocks are down about 20% or so this year since the early, and it's all based on the uncertainty of what a bank liquidity position is like.
And are banks doing more portfolio? Explain what portfolio loans are.
So portfolio loans are basically jumbo loans. There are times when we'll put something in a portfolio that we like that maybe isn't saleable to Fannie Mae or Freddie Mac, but generally those portfolio loans are loans that are above the largest loan that the Fannie Mae or Freddie Mac allow, which is at $726,200. Those loans go into a bank portfolio. We just keep them on our books. Because banks are issuing out a little more liquidity, and the concern out there, I would say that portfolio at lenders has been stressed a little bit. It's still plenty available, but you'll find players that were kind of marginal players in a portfolio world that are kind of shrinking their access to portfolio. So I think U.S. Bank ended the fourth quarter as the fourth largest portfolio lender. So that's one of the great things about being with a large bank.
Right. Have I missed anything?
No, I don't think you have. You've done a great job.
Well, thank you for tuning in today. And Robert, we've been dealing, like you said, 20 years, and I highly recommend Robert. He's also an ex-Marine, right?
Yes.
So,
hoorah.
Thank you for tuning in, and see you next week.